Hey, good morning, everybody. Glad you joined us this morning. Getting ready to talk to Dave here in just a few moments. But again, I want to remind you of the free report that we have that we offered yesterday, and we offered a couple times last week. But it's a great report. Retirement is not a get a second chance type thing. When you get ready to retire, it's kind of a one and done. And so we've put together a free report on retirement strategies that could help you get through retirement. And this is good for people who have already retired or for people that are 5 to 10 years out from retirement to help you start getting your ducks in a row. So we've put together this report, easy to get your hands on it. All you have to do is text the word retirement to 863-285-3815. That's right. Text the word retirement to 863-285-3815. Hey, I appreciate it. Dave will be with us just a moment.
105.7 Lights FM. Kelly's there. Dave's here. It's 8:40, and guess who also is here? Same place we go every morning to find out what's going on with your money. Phillip Statler, who's downtown. His office is at Statler Financial Services in downtown Sebring. Let's see what's happening this morning. I got a sneaking hunch it's going to be Dramamine season in the markets. Phillip, would you tend to agree with that? Dramamine needed?
It's definitely starting to look that way, Dave. I mean, we're having definitely some waves, ups and downs and ups and downs. And so yesterday we ended up a little bit. Today it looks like we're going to start the day down.
Yeah, yesterday I was kind of thinking that after 600 points a day before, we were probably going to correct that by a little bit. Now we're going to correct a little bit more exuberance than we needed yesterday and go back down. And based on the fact that the Chinese premier and President Trump aren't even slated to talk to each other until we get to the G8 summit next month, I got a sneaking hunch we got about a month of this crud to put up with, don't we?
Well, I'm guessing so, Dave. I mean, it's going to be the rumor mill that's going to drive the marketplace. It's going to be the president's tweets. All those things are going to affect the stock market until we get some idea of when this thing's going to get resolved.
Yeah, absolutely. In terms of the macro front this morning, kind of interesting. We actually have a retail sales comparison because both China and the United States issued our retail sales report, and it was not what you wanted to see. They did revise the March number upward. That needs to be noted, but the April retail sales fell by 0.2% as a data point that isn't necessarily bad, but we were expecting growth, I gather.
We were. The expectation was the exact opposite. We were expecting a 0.2% increase in retail sales, and instead we got a 0.2% decline. And if you remember back when we talked about March, March was finally seeing some strong numbers come through because the other 2 months, January and February, had not really been that great.
Absolutely. The March number, I think, was revised upward by like 0.2%. So, it remains a solidly good number. But then you take it across 4 months of the year, three of them have been disappointments, and one of them was a pleasant surprise. You take the smoothed average, and I guess the reaction is, pretty much overall.
Yeah, I think so. That would be a good way of putting it, Dave.
It kind of averages out to kind of modestly stinky, which is kind of sort of what we were talking about. Thinking about modestly stinky, kind of intriguing. China also released some retail sales figures, which we always throw out with a little bit of the caveat that this is a command and control economy. So when China admits things are disappointing, they probably really stink in reality because the government ain't necessarily going to tell us the truth over there.
Well, and that's true. They've missed a lot of their data points also. And so their retail sales numbers came out. Now, this is in context to not our economy, but their economy, right? So their retail sales rose and they put just 7.2%. But that's the lowest increase in retail sales since May of 2003. And so they expected it to be 7.5% at the lowest point. Some people expected it to be 8.6% growth. So you look at that, and that's a pretty big miss for the Chinese over there.
Absolutely. It needs to be thrown out for backdrop that basically any growth figure in China that's less than double digits starts showing signs of a recession because they grow so doggone fast over there. Their economy is still classified as developing over a lot of the country. That seven and change is a major disappointment and an indication that the trade war, even the threats of it last month, are already having an impact.
Yeah, they are. And the other thing, there's two other numbers here that they've given us in this report. Industrial production growth slumped from a hope. They hope to have came in at plus 6.5% year to date. Year over year in March, they were only up 6.2%. So that was a miss. And then their fixed asset investment slowed to just 6.1%. I kind of laugh because it says just, and we would be thrilled with these numbers here in the United States. But in China, those are some disappointing numbers. And one of the things I read was, the indexes over there are not indicating that this is really putting any pressure on them. And that's because the hope of the traders is that the Chinese government's going to come in and prop things back up. So there's not this mass liquidation in China because of what the government usually does in terms of stepping in and propping up their indexes.
And you got to keep in mind, too, that the Chinese markets have been in bear territory now for, oh, heavens knows, like 3 to 5 months. So, I mean, there's a floor below which anything can fall. And in a command and control economy, the floor gets a little bit harder, doesn't it?
Yeah, it does. You're right. And so it's if you talk about a world economy and we have issues in seeing a slowdown in China, and if we start to see a slowdown here, that kind of gives you some indication of what we may be seeing worldwide.
Absolutely. It may end up getting to the point of who can wreck whose economy first. And conventional wisdom is that we can do more damage to China than they can for us, but that doesn't mean we have to like the trip whatsoever one little bit. Leads us to the President Trump tweets and all of the pundits talking about the Federal Reserve. Yesterday, we had one of the Fed governors who sit on the open market committee saying, yeah, we're just going to hold steady. The odds makers saying this morning the odds of a rate increase have gone down to basically zero, but the odds of our Federal Reserve decreasing rates, it'd pretty much take a full bear market on our side of the fence in order to make our Federal Reserve change their mind the way things look right now, too. So don't look to the Fed for stimulus, I gather.
Well, and probably not. And from an economic standpoint, rightly so. We don't want to see the Fed step in every time there's this terrible thing happening, because we already know from what happened in 2008 that there's consequences from doing that, and they're not always what we think they're going to be.
Absolutely. In an economy that's being affected by one readily identifiable cause, like a trade war, overcorrecting on the part of the Fed, that's where you start getting into all the concerns about hyperinflation. And once you get that junk taking off, it's really a beast to rein back in as well. So while it may not be pleasant, I'm really not tickled pink at the notion of having the Federal Reserve stepping in right away either.
Well, the other thing you have to remember is every economy has business cycles. And if you mess up that cycle, then you're asking for trouble, because all you can do is prolong the cycle. The cycle is going to happen. We have been in an economic expansion, and at some point we go into a contraction. And so we're kind of in the late stages of the expansion. It is only normal for us to eventually hit a contracted period of time.
That's absolutely. It's the other side of the same coin. Yeah, one thing, it's hard to fix the damage you cause by doing it, and then at the same time, there's a disciplinary reason for not wanting to change things either.
That's right, because once you come
Yeah.
out of the contraction, then you hit expansion again, and so the ebbs and flows of the economy are what makes the economy continue to grow.
Absolutely. Looking at the reports that are coming out, it always seems like anticlimactic. I mean, normally on normal day-to-day business, we'd say, okay, here's the economic situation. The reports are going to drive the market, but pretty much everything is getting driven by the doggone trade war. We did have one really fascinating bit of good news, because we're not used to talking nice things about brick and mortar retailers. Macy's just absolutely kicked butt on most of the macros on their quarterly reports. Same store sales, profit all beat. revenue was just off a little bit, and the investors are just having party time with them, aren't they?
Well, they are. The earnings came in about 11 cents higher than expected. Revenue I mean, missed by just a tinge. Same store sale, which is one of the key metrics that we use in retail, was expected to be down, a decline of 0.2%, but it actually was up 0.7%. So some really good news there for Macy's. Now, one of the things I did see in the report is that their online sales have really started to take off, and that's been a big boom for Macy's and helping them quite a bit. Now, they're still up. They're up almost 3% this morning before the market opens up. That's trimmed down a little bit. They were up as much as about 4%, I think. But I think one of the other indicators here is that they are, at least they closed yesterday, within $1 of their 52-week low. And so I think that also helps with the upward movement at Macy's today.
I kind of found the observation that their online sales were improving interesting, because that's the biggest challenge. You got brick and mortar, you want to support the physical store structure you got, but the fact of the world as it is today, you pretty much got to be doing some business online in order to survive. And if Macy's is succeeding in that level, that's a good sign for the future for them.
Well, it is. They're making some inroads there. Definitely some good stuff there. Hey, on the other side, we've got, we've been talking about China a lot today. And so Alibaba, one of the main big Chinese e-commerce giants, came in and they beat by a little over 20 cents, 25 cents. I think I saw. It's not in my main report. But they had a great quarter. They've had increases in both user engagement and growth in their cloud business. Remember, Alibaba to China is a lot like Amazon is to us here in the United States. And they're not up as much as they were earlier, but they're still up about 0.25% this morning.
It'll be interesting to see on the next quarter what happens to Alibaba with the trade war as it goes, and how on earth they're going to be able to handle the tariffs on the direct shipments over here.
Well, that's true. You're right. That will have some impacts, I'm sure. And then we have
how they're going to pay them. That's going to make that. I just have no idea how they're going to enforce them if they do happen. So it's going to be an interesting question when that comes up, and I'll bet you there's going to be an interim report somewhere.
Well, that could be. That's true. But typically Alibaba, though, I mean, if they ship out of there, I would think everything's got to go through some customs process. And so that could be where it hits when it comes into the United States. It still has to go through some customs process. If they have a warehouse here in the United States, they're going to bulk ship here, which means it's going to still come through customs. So one way or another, I'm sure we'll get our money.
I think that's probably a fait accompli would be the term. Other indications from the companies reporting this morning.
So interestingly, I have two cannabis companies this morning reporting. We have Tilray. They came in better than expected by about 2 cents a share. Remember, they're a Canadian marijuana producer. Their revenue came in a little bit above estimates. And a lot of that was helped because they've made some acquisitions of other marijuana growing facilities. And then the legalization of the recreational use of marijuana in Canada has helped them quite a bit too. So they're trading up. They're traded on the NASDAQ, actually. They're trading up about 1.9%. Now, I find this interesting. I'm looking at the 52-week range right now, and that range is from $20.10 a share to $300 a share.
Wow.
Yeah, and right now they would open right now at about $49.65 a share. Yeah.
Those stocks fascinate me to be good with. A product that's technically still illegal in this country on the federal level, but it's becoming a glamour investment level with sometimes some irrational exuberance.
Oh, definitely.
Absolutely. Setting the table for the morning. Yesterday was an up day like we observed at the outset. Dow was up 207, NASDAQ up 87, and the Standard & Poor's up by 22.5. All pretty solid increases, although nowhere near what we lost the day before. Irrational exuberance from yesterday, I'm betting, because I'm seeing red ink this morning. Phillip, how fast are we falling 45 minutes early?
We are gaining up some speed on the downside. I will say that when I woke up this morning, The Dow was down less than 100 points. When I got to the office, it was down about 140. Right now, the Dow is down 181 points, which is a little over 0.7%. The S&P 500 is down $21.20, which is 0.75%. The Nasdaq's right in there with them, down 0.8%, $60 on that index. So gold is trading back up to $1,300 an ounce. Silver still not quite getting to 15. It's at $14.80 an ounce. And we're seeing a decline again on crude oil, down to $61.03 a barrel, which is down 1.2% from yesterday's close.
Not sure I can explain that, but I'm happy to see it, right?
Exactly, because I see that there's a shortage in Europe, oil shortage.
No, evidently not here. Overseas markets, you made mention earlier, Philip, that the Asian markets, especially the mainland China markets, were not responding negatively so far. Asian markets generally up at the close this morning. Europe, on the other hand, is a bad case of our flu. They're all running off 45 minutes before we open. Somebody needs some help in terms of stabilizing and figuring out how to make retirement work in the case of days like this. Philip, how do I find you on the phone?
Well, Dave, with all the volatility, now is the time to make sure that you don't have too much risk in your current portfolio and make sure that it lines up with your risk tolerance. And to do that, you can call and schedule your x-ray report. Call us at 863-382-0037. Follow us on our website at statlerfinancial.com, and then like our page on Facebook, Statler Financial Services. We post a lot of stuff there. This report gets put back on there every day. And then join us every weekend for the Statler Financial Radio Show, noon on Saturdays, 10 a.m. Sunday mornings on News Talk 7:30 a.m.
I do appreciate it, sir, and we will check in tomorrow morning and cross our fingers that we managed to stem the tide a little today.
All right, man. Have a great day. Hey, again, I want to thank you for joining us today on today's show. I hope you got some good information about China's economy, our economy, some of the big picture items we talked about today. But I do want to remind you again of our free report when it comes to retirement strategies. Given a lot of the volatility out there in the marketplace, a great report to get you to start thinking about retirement. And if you've already retired, it's a must-have. All you have to do to get your report is text the word retirement to 863-285-3815. That's right. Just text the word retirement to 863-285-3815. Hey, thanks for joining us. I look forward to speaking with you again tomorrow.